So I see that it is the top of the hour, and for those of you just joining us, welcome to today's webinar, Mortgage and Other Interest Expense Allocation and Apportionment for Individuals with Partnership Interest, Form 1116 in Schedule K-3. We're glad you're joining us today. My name is Anika Pompey, and I am a Senior Stakeholder Liaison with the Internal Revenue Service. I'll be your moderator for today's webinar, which is slated for approximately 60 minutes. Before we begin, if there's anyone in the audience that is with the media, please send an email to the address on the slide and be sure to include your contact information in the news publication you're with. Our media relations and stakeholder liaison staff will assist you and answer any questions you may have. As a reminder, this webinar will be recorded and posted to the IRS Video Portal in a few weeks. This portal is located at www.irsvideo.gov. Please note, continuing education credit or certificates of completion are not offered if any version of our webinars are viewed after the live broadcast. So again, we hope you won't experience any technology issues, but if you do, this slide shows helpful tips and reminders. We've posted a technical help document you can download from the materials section on the left side of your screen. It provides the minimum system requirements for viewing this webinar, along with some best practices and quick solutions. If you've completed and passed your system check and are still having problems, try one of the following. Close the screen where you're viewing the webinar and relaunch it, or you can click on Settings on your browsing viewer screen and select HLS. You should have received today's PowerPoint in a reminder email, but if not, no worries. You can download it by clicking on the Materials drop-down arrow on the left side of your screen, as shown on the slide. Closed captioning is available for today's presentation. If you're having trouble hearing the audio through your computer speakers, please click the Closed Captioning drop-down arrow located on the left side of your screen. This feature will be available throughout the webinar. If you have a topic-specific question today, please submit it by clicking the Ask Question drop-down arrow to reveal the text box. Type your question in the text box and click Send. And this is very important. Please do not enter any sensitive or text-specific information into the chat. So during the presentation, we'll take a few breaks to share knowledge-based questions with you. At those times, a polling question style feature will pop up on your screen with a question and multiple choice answers. So select the response you believe is correct by clicking on the radio button next to the selection and then click Submit. Some people may not get the polling questions, and this may be because you have your pop-up blocker on. So please take a moment to disable your pop-up blocker now so you can answer the questions. We've included several technical documents that describe how you can allow pop-up blockers based on the browser you are using. We have documents for Chrome, Firefox, Microsoft Edge, and Safari, and you can access them by clicking on the Materials drop-down arrow on the left side of your screen. So we're going to take some time and test the polling feature. And here's your opportunity to ensure your pop-up blocker is not on so you can receive the polling questions throughout the presentation. Now here's your question. Have you ever downloaded an IRS National Webinar recording from the video portal? Answer A for yes, B for no, or C, where is the video portal? Now take a moment and click the radio button that corresponds to your answer. And I'll read that one more time. Have you ever downloaded an IRS National Webinar recording from the video portal? Answer A for yes, B for no, C for where is the video portal? And I'll give you a few more seconds to make your selection. Okay, so we're going to go ahead and stop the polling now. Let's see how the majority of you responded. Okay, so I see that 70% of you selected no. All right, so we hope that you received the polling question. Oh, I'm sorry, and 29% of you responded yes. So we hope that you received the polling question and was able to submit your answer. If not, the time to check your pop-up blocker. Now's the time to check your pop-up blocker to make sure you have it turned off. Again, we've included several technical documents that describe how you can allow pop-up blockers based on the browser you are using. Just click on the Materials drop-down arrow on the left side of your screen to download the browser document. Again, I want to welcome you all, and we're glad you joined us today for today's webinar. Before you move along with our session, let's just make sure you're in the right place. Today's webinar is Mortgage and Other Interest Expense Allocation and Apportionment for Individuals with Partnership Interest, Form 1116 and Schedule K-3. This webinar is scheduled for approximately 60 minutes. So let's go ahead and introduce today's speakers. First, we have Jim Wu. Jim is a senior revenue agent in large business and international, specifically in its withholding, exchange, international, individual compliance division, and the Foreign Tax Credit Practice Network. Jim joined the IRS in 2010. Next, we have Patricia Mirando, who is also a senior revenue agent with withholding, exchange, international, individual compliance division, and the Foreign Tax Credit Practice Network. And from the Office of Associate Chief Counsel International, we have John Lee and Karen Kate. And I'm going to go ahead and turn it over to Patty to begin the presentation. Patty, the mic is yours.
Thank you. Good day, everyone. This is our agenda for today. What we're going to be doing today is explain the relevance of interest expense allocation and apportionment to the foreign tax credit limitation. We're going to explain the special interest expense allocation and apportionment rules for individuals. And finally, we're going to explain the interaction of the partnership and individual interest expense allocation and apportionment rules. Here we have the acronyms that will be referenced today, and that's FTC for Foreign Tax Credit, IRC for the Internal Revenue Code, USP as Domestic Partnership. Before we delve into the rules on interest expense apportionment, let's review some FTC limitations. U.S. citizens and U.S. residents are allowed a credit against their U.S. income tax liability for income taxes paid or accrued to foreign countries and U.S. possessions. In other words, that's the foreign tax credit, and that's in lieu of deducting such taxes. That's IRC Section 27 and IRC Section 901. The FTC limitation under IRC 904 is the fraction, the numerator of which is the foreign source taxable income, and the denominator is the worldwide taxable income. The resulting percentage is then multiplied against U.S. tax liability. Now note that the foreign source taxable income in this fraction cannot exceed the taxpayer's entire taxable income. This fraction for the FTC limitations is expressed on Form 1116, Part 3. The FTC limitation formula is computed by separate category of foreign income under IRC Section 904D. The IRS has published a practice unit, Foreign Tax Credit, Categorization of Income and Taxes into Proper Baskets, that discusses this concept in more detail. The foreign source taxable income is the gross income. It's the gross foreign source income for a particular income category or basket, minus any deductions, including deductible expenses and losses. Deductible interest expense is one of these deductions. The interest expense that is used in the FTC limitation determination is what's reported on the Form 1040 as deductible interest expense. Individuals have special rules for apportioning interest expense that differs from the rules that apply to corporations. Individual taxpayers apportion deductible interest expense amongst the various categories of what we call baskets of income. And some of these are general and passive, among others, that's based on the type of interest expense. The types of interest expense identified in the rules are qualified resident interest, which is your home mortgage interest, business interest, investment interest, and passive activity interest. If the individual is a partner in a partnership, the individual must consider the partnership's interest expense and apportionment factors. An individual is not required to follow the apportionment rules for interest expense discussed in the prior slides if the individual's foreign source income is less than $5,000. In this case, the interest expense is allocated entirely to domestic source. For this purpose, any income excluded under IRC Section 911 is included in the $5,000 threshold. And now I'm going to turn it over to Jim to discuss mortgage interest. Jim?
Thanks, Patty. Home mortgage interest expense is apportioned by multiplying the ratio of gross foreign source income for a particular category of income or basket of income divided by gross income from all sources. For this purpose, we do not include any income excluded under the foreign earned income exclusion under Section 911 on the Form 2555. The Form 1116 instructions provide a worksheet to do the apportionment for the mortgage interest expense, and we will be looking at an example in just a few minutes. Note that this general rule does not apply if the home is a rental property. Rather, the business interest or passive activity interest rules, which we will discuss momentarily, will apply to mortgage interest related to rental property. As mentioned previously, if the individual taxpayer owns interest in a partnership, information from the Schedule K-3 should be taken into consideration when apportioning interest expense. Different rules apply depending on how the partnership is owned and the percentage of ownership. How mortgage interest expense is apportioned is different for an individual who is a general partner or an LP limited partner with at least 10% ownership interest versus a limited partner with less than 10% ownership interest. To apportion home mortgage interest expense, an individual who is a general partner or limited partner with at least 10% ownership must take into account his distributive share of partnership income by source and category. This information comes from Schedule K-3, Part 2, Section 1, columns A through E. And in certain cases, the partner will need to determine the source of income. For example, when the source depends on the partner's residence, and that will be reported in column F. A classic example of this is a sale of capital assets. This slide is just a snapshot of the Schedule K-3, Part 2, Section 1, so you can visualize the part of the Schedule K-3 we just referred to. Note that in Section 1 continues onto another page, but we're not depicting that here. The information in Part 2, Section 1, columns A through F, is used by the partner to allocate and apportion home mortgage interest expense. When it comes to a limited partner with less than 10% interest, the individual partner must similarly take into account her distributive share of partnership income to allocate and apportion partner's home mortgage interest expense. The difference here is that all foreign source income from the partnership will be classified as passive income. So we'll now look at an example. And in this example, the taxpayer has deductible mortgage interest from the Form 1040 Schedule A, and that amount is $25,000. Taxpayer is a 10% limited partner in a domestic partnership. Taxpayer's distributive share of foreign source general category income from the partnership is $20,000, and that is shown on the Schedule K-3, Part 2, Section 1, Column D. The taxpayer also has a distributive share of foreign source passive income of $6,000, which is shown on Schedule K-3, Part 2, Section 1, Column C. And for this example, the taxpayer has no other foreign source income. And the taxpayer's gross income from all sources is $75,000. Again, because the taxpayer is at least a 10% partner, even though the taxpayer is a limited partner, the mortgage interest expense is apportioned in part based on the distributive share of foreign source income by source and category as reported on the Schedule K-3. The individual taxpayer must also include any income not from the partnership to allocate and apportion the interest expense. In this case, as we noted, the taxpayer did not have any foreign source income outside of the partnership. So now we'll use the worksheet that's contained in the Form 1116 instruction to do the actual apportionment. First, we'll do the general category. The only foreign source income that is distributed is a distributed share of partnership income, and that part is the general category, which is $20,000. That is entered on line 1. And the gross income from all sources is $75,000 per the facts of the case. And this goes on line 2. Line 3 is the apportionment percentage determined by dividing line 1 by line 2. Line 4 is a $25,000 mortgage interest expense, and that is multiplied by the apportionment percentage to determine the amount apportioned to the general category, and that's on line 5, and the number is $6,668. This apportioned amount goes on line 4A of the Form 1116 general category. Next slide. Again, we use the worksheet to apportion the mortgage interest to the passive category. We just went over the general category. Now we're doing the passive. Again, the passive income from the partnership is $6,000. Total gross income from all sources, $75,000. Dividing line 1 by line 2, we get the apportionment percentage, 0.08. Total mortgage interest expense is $25,000. Multiplying that by the percentage, we get $2,000. And that goes on line 4A of the Form 1116 passive category. Now we want to talk about interest expense other than the mortgage interest expense. This would go on line 4B of the Form 1116. The other interest expense, as Patty mentioned previously, is comprised of business interest expense, investment interest expense, and passive activity interest expense. The general rule is that these types of interest expense should be apportioned using the taxpayer's asset value. For example, business interest expense is apportioned proportionately to each category of income based on the amount of business assets assigned to the category of income divided by the total amount of business assets. And the Treasury reg for this is cited on this slide. Okay, now we're ready for our first polling question. And for that, I'm going to turn it over back to Anika. Anika?
All right, Jim. Thanks so much. So, audience, here is our first polling question. Interest expense requiring apportionment includes which of the following? A, mortgage interest expense, B, business interest expense, C, investment interest expense, or D, A, B, and C. So let's take a moment and click the radio button that best answers the question. I'll read that one more time. Interest expense requiring apportionment includes which of the following? A, mortgage interest expense, B, business interest expense, C, investment interest expense, or D, A, B, and C. I'll give you guys a few more seconds to make your selection. All right, so we're going to stop the polling now, and let's share the correct answer on the next slide. And the correct response is D, A, B, and C. All right, so it looks like 87% of you responded correctly. That is a great response rate. So Jim, I'll go ahead. John, it looks like I'll turn it back over to you to continue the presentation.
Thanks, Anika. As with mortgage interest, there are different rules for apportioning other interest expense depending on how the partnership interest is held, whether the individual partner is a general partner or limited partner with at least 10% ownership interest, or if the individual partner is a limited partner with less than 10% ownership interest. For general partners or limited partners with at least 10% ownership interest, the individual partner has to add his distributive share of partnership interest expense to his other interest expense, classified as business interest expense, investment interest expense, or passive activity interest expense. This information comes from the Schedule K-3, Part 2, Section 2, lines 41 through 43. These lines report out any distributive share of other interest expense, business, investment, or passive activity. Next, the individual partner has to add to his assets the pro rata share of the inside basis of partnership assets, also by classification as business assets, investment assets, or passive activity assets. This information comes from the Section K-3, Part 3, Section 2, lines 6B through 6D, a part of the Schedule K-3 that shows the interest expense apportionment factors. The next two slides are snapshots of the part of the Schedule K-3 just referred, so you can visualize what we are talking about. Schedule K-3, Part 2, Section 2, lines 41 through 43, report the partner's share of the partnership interest expense by classification as business, investment, or passive activity. Then on Schedule K-3, Part 3, Section 2, lines 6B through D, report the partner's share of the assets by classification as business, investment, or passive activity. For example, the partner's business interest expense, including the distributive share of the business interest expense of the partnership, is allocated in proportion to the partner's business assets, including the ratable share of the business assets of the partnership. We will show an example later on. The partnership asset values as reported on Schedule K-3, Part 3, Section 2 for apportionment purposes are generally computed based on the average of the inside basis of the partnership assets at the beginning and end of the year. Certain assets are excluded from this average inside basis. For example, tax-exempt assets. Again, we're showing a snapshot of the Schedule K-3, Part 3, Section 2, which shows the average values of the distributive share of assets on line 1. Lines 3 through 5 are excluded from assets used in apportionment, including, for example, tax-exempt assets. Under the tax book value method, the value of an asset is determined based on the adjusted basis of the asset. This is not necessarily what you will see on the Form 1065 Schedule L balance sheet per books. So, for example, in the initial tax year, a building is purchased for $1 million, and the building is depreciated for book purposes on a less accelerated method than for tax purposes. Then, after depreciation is applied for a few years, in the year at issue, the building's value for book purposes on Schedule L is $500,000, but for tax purposes, including for allocating and apportioning interest expense, it could be $200,000. Some interest expense is directly allocable under the Treasury regulations stated on the slide, A61-10 or A61-10T. Schedule K-3, Part 2, Section 2, lines 39 to 40 are used for this purpose. The sourcing and category of this type of interest expense is indicated under columns B through E. Assets used to apportion non-directly allocable interest expense do not include assets attracting directly allocable interest expenses. This is subtracted on lines 3 and 4. Individual partners should report this directly allocable interest expense on Form 1116, line 4B. We are now going to go to the next poll question.
All right, so it is time for that next poll question. So audience, here is our second polling question. To apportion other interest expense on Form 1116, line 4B, the partner should look to which part of the Schedule K-3 for apportionment factors? A, Part 3, Section 2, lines 6B through 6D. B, Part 2, Section 2, lines 41 through 43. C, Part 3, Section 2, lines 1 through 6A. Or D, none of the above. I'm going to read that one more time. To apportion other interest expense on Form 1116, line 4B, the partner should look to which part of the Schedule K-3 for apportionment factors? A, Part 3, Section 2, lines 6B through 6D. B, Part 2, Section 2, lines 41 through 43. C, Part 3, Section 2, lines 1 through 6A. Or D, none of the above. So just take a moment and click the radio button that best answers the question. I'll give you a few more seconds to make your selection. All right, so we're going to go ahead and stop polling now, and let's share the correct answer on the next slide. Okay, so the correct response is A, Part 3, Section 2, lines 6B through 6D. Now let's see how well you guys did with this question. Ooh, all right, so it looks like only 22% of you responded correctly. So John, can you clarify this question for us?
Sure. Form 1116 4B includes interest expense other than home mortgage interest expense that reduces foreign source income. Interest expense other than home mortgage interest is generally apportioned based on assets in the same grouping, whether business, investment, or passive activity. So Part 3, Section 2, lines 6B through 6D contain the partner's distributive share of these assets in the groupings identified, business, investment, or passive activity.
All right, John, thank you for the explanation and a great job to everyone. Karen, it looks like I'm going to be turning it over to you to continue the presentation. So the mic is yours.
That is correct. Thanks, Anika. Hello, everyone. Welcome to our webcast today. So moving on to the next slide, now we're going to look at a different set of rules that apply to limited partners with a less than 10% ownership interest. A partner who has this level of ownership may allocate her share of the partnership's interest expense to her distributive share of partnership gross income. So because the foreign source portion of the distributive share of the partnership gross income is classified as passive category income in this particular ownership fact pattern, the portion of the partner's interest expense allocated to that foreign source is treated as passive category income as well. There are certain exceptions to this rule, such as high tax income. So moving on, the partnership will not complete, in this scenario, the partnership will not complete Schedule K-3, Part 3, Section 2, for interest expense apportionment for an individual limited partner who has this less than 10% interest because of this special rule for the passive treatment. When apportioning the partner's interest expense on an asset basis, the partner's interest in the partnership is the relevant asset instead of the partner's distributive share of the partnership's assets. So the partner's interest in the partnership is assigned to the categories of income in the same manner as the partner's share of the partnership interest expense is generally allocated. That is, only to either passive category foreign source income or domestic source income. And the authority for this rule for individuals with a less than 10% limited partner is under Treasury Regulation Section 1.861-9T for temporary, E for Romanet 2. We'll now go to our next polling question. Thanks for your help, Anika.
Yes, thank you, Karen. So audience, it is time for our third polling question. So in general, for a limited individual partner with less than 10% ownership interest, the portion of his share of interest expense that is allocated to foreign source income as opposed to domestic source income is treated as allocated to which category of income? Is it A, general, B, passive, C, foreign branch, or D, none of the above? I'll read that one more time. In general, for a limited individual partner with less than 10% ownership interest, the portion of his share of interest expense that is allocated to foreign source income as opposed to domestic source income is treated as allocated to which category of income? Is it A, general, B, passive, C, foreign branch, or D, none of the above? Let's take a moment and click the radio button that best answers the question, and I will give you guys a few more seconds to make your selection. All right, so all right, so the correct response is B, passive, and it looks like 76% of you responded to that correctly. So, Carrie, would you mind clarifying that for us?
Sure, Anika. So as I explained a few slides ago, there is a special rule that allows a partner that is a limited partner that owns a less than 10% ownership interest in the partnership to treat the foreign source income that its distributed share, the foreign source income that it receives, with respect, not that it's distributed share of the partnership income as foreign source passive income, would always be in the passive basket in that particular scenario. So please look out for that rule that kind of eases the burden of tracking the separate category of income. So now,
all right, Karen.
oh, go ahead.
I'm sorry, Karen. Thank you for that explanation. I'm going to turn it back over to you.
Sure, great. So now we are going to move on to an example where hopefully we can pull this all together. So we have A, who is a U.S. citizen, who owns 10% interest in USP. And remember, USP is a domestic partnership. And this domestic partnership is engaged in the active conduct of a U.S. trader business. USP's business generates only domestic source income, and USP separately has an investment portfolio consisting of several less than 10% stock investments that generate both domestic source and foreign source passive income. USP has a bank loan, the proceeds of which are divided 60% and 40% between the business and the investment portfolio. And A's only business assets and investment assets are its distributive share of those owned by the U.S. partnership. Continuing on with the facts, A's only interest expense is that from its distributive share of USP's interest expense, $3,000 for business activity and $2,000 for investment activity. The $3,000 business interest expense must be apportioned on the basis of the business assets. And recall that this business interest expense is reported on Schedule K-3, Part 2, Section 2, Column F, line 41. A's distributive share of USP's business assets is $72,000. And those assets generate solely domestic source income because it only is in a U.S. business. That amount of $72,000 is reported on Schedule K-3, Part 3, Section 2, Column A, line 6B. So the distinction being that the interest expense is reported on Part 2, and then these assets that are used to do the apportionment are reported on Part 3. Note that the $3,000 of business interest expense needs to be determined at the partner level in terms of the sourcing because it's reported under Column F. And since the business assets attracting business interest expense are all U.S. sourced, the entire $3,000 of business interest expense is apportioned to U.S. source and need not be reported on the Form 1116. And that is because on the Form 1116, it is only required to be reported foreign source income, not U.S. source income. And we'll see this in a moment illustrated. So $3,000, again, is apportioned to U.S. source income by the partner and does not need to be reported on the Form 1116. But we still have the $2,000 of investment interest expense that does need to be apportioned on the basis of investment assets. And again, just like the business interest expense, the investment interest expense will also be reported on Schedule K-3, Part 2, Section 2, and Column F, but it will be reported on line 42, which is designated for the investment interest expense, whereas line 41 is designated for the business interest expense. Continuing on with the facts, A's distributive share of the adjusted basis in USP stock is $20,000, with respect to which $8,000 is the stock generating domestic source income, and $12,000 is with respect to the stock generating foreign source passive income. So these amounts, the $20,000, the $8,000, and the $12,000, are reported on Schedule K-3, Part 3, Section 2, line 6, columns A and C respectively. So this is where we explained to you before that the assets are reported by the source of income which they generate and the separate category, and Part 3 has those there for apportionment purposes. 800 is apportioned to domestic source income and does not need to be reported on the Form 1116 because just like the gross income, the expense allocated to U.S. source income does not need to be apportioned to, does not need to be reported to, if it's U.S. source, does not need to be reported on the Form 1116. And the way that this 800 was derived was by taking the total adjusted basis in USP stock of 20,000 at the denominator, and the portion that is generating domestic source income of 8,000 of that 20,000 is multiplied by the 2,000 of interest expense. The same rule applies for purposes of determining the foreign source portion of that 2,000 interest expense. So because there's only two types of income generated by the stock, the domestic source income and then the foreign source passive income. The remaining amount of 2,000 of the would be apportioned to foreign source passive income of 1,200. And so now we see that we look here on this slide so that you can see what it looks like when you receive a Schedule K-3. When the partner receives a Schedule K-3, the partner will look to Part 2, Section 2, line 41 and 42, and the partner will see on line 41 here that other interest expense, that's business expense, is 3,000 reported in column F and column G, and then the portion of the interest expense that's aligned with investment interest expense of 2,000 is here on line 42. And then in terms of the apportionment factors that are utilized to allocate and apportion the interest expense, the partner would look to Part 3 of its Schedule K-3, and in particular Section 2 is where the interest expense apportionment factors are. And so here in total, you'll see that 72,000 assets are attracting domestic source of the total 80,000. So the 3,000 of the related interest expense is all domestic source and need not be reported on the Form 1116. However, as we discussed before, the 2,000 does need to be apportioned to domestic source and passive category foreign source. And you can see here how that's broken up. So here we have on line 6A, we have the 80,000, but then there's for domestic source in column A, but we also have 12,000 in passive category of assets. And then we also in total have 92,000. There's 72,000 that generate domestic source. There's 8,000 of these that generate domestic source in the investment category. That 72 is in the general category, business category. And then we have 12,000 again on line 6C to differentiate the types of income that is being generated by the assets so that the partner can do the allocation and apportionment. So now we'll move on to our final polling question, Anika.
Yep, Karen, we are at our final polling question. So audience, here is your fourth and final polling question. Which assets are taken into account by an individual that owns a 10% interest in a partnership when allocating their other interest expense? Is it A, asset owned by the individual, B, assets owned by the partnership, C, A and B, or D, none of the above? I'm going to read that one more time. Which assets are taken into account by an individual that owns a 10% interest in a partnership when allocating their other interest expense? Is it A, assets owned by the individual, B, assets owned by the partnership, C, A and B, or D, none of the above? Take a moment to click the radio button that best answers the question, and I'll give you guys a few more seconds to make your selection. All right, so we're going to go ahead and stop the polling now, and let's share the correct answer on the next slide. And the correct response is C, A and B. Now let's take a look and see how many of you responded correctly. Okay, so it looks like only 64% of you responded correctly to this particular question. So if you don't mind providing an additional explanation in regard to this question, I think that will help the audience a lot. Karen.
Sure, Anika. The main point that we wanted to emphasize with this webinar is the fact that when an individual who's a partner in a partnership has a flow-through amount of interest expense from a partnership, in terms of determining the amount, how to allocate and apportion that interest expense to foreign source income and U.S. source income, the partner cannot simply look to its own assets aside from its partnership interest. It needs to look through, in most cases, to the partnership's assets, and so that's why the partnership reports on Schedule K-3 the partner's distributive share of the value of the assets, so that the partner can add both those assets, its distributive share of the partnership assets, to its own assets, and doing the interest expense allocation and apportionment for that interest expense that requires an asset allocation and apportionment. Thanks, Anika.
No, thank you for that explanation. So great job to everyone. Now, I believe we have some resources to share. So Patty, can you show us the resources?
Absolutely. Thank you, Anika. On this slide, you're going to see some of our recommended resources. And these are the instructions to the schedules. They're very good examples in these instructions that will further clarify the allocation and apportionment of interest expense. And so look at the slide, read the instructions, and it'll guide you. And Anika, that about wraps it up for us.
All right. So thank you so much for that, Patty. So hello, audience. It's me again, Anika Pompey, and I am going to be moderating the Q&A session. Before we start the Q&A session, I do want to thank everyone for attending today's presentation, Mortgage and Other Interest Expense Allocation and Apportionment of Individuals with Partnership Interest Form 1116 and Schedule K-3. Now, earlier we did mention that we want to know what questions you have for our presenters, so here is your opportunity. If you haven't input your questions, there's still time, so go ahead and click on the drop-down arrow next to Ask Questions field and type your question and click Send. Jim, Patty, Karen, and John are all staying on with us to answer your questions. But one thing before we get started, we may not have time to answer all the questions submitted. However, let me assure you that we will answer as many as time allows. If you're participating to earn a certificate and relating continuing education credits, you will qualify for 1 credit for participating for at least 50 minutes from the official start time of the webinar, which means the first few minutes of chatting before the top of the hour does not count towards the 50 minutes. Let's go ahead and get started so that we can get to as many questions as possible. All right, so I have my first question here. And Jim, I am going to direct this question to you. What happens if you do not itemize deductions?
Yeah, Anika, that's a very good question. I think we got 3 questions on the same, actually 3 questions on the same topic. So if a taxpayer does not itemize, meaning the taxpayer most likely took a standard deduction, then in that case, there's no apportionment necessary on line 4A of the Form 1116, meaning there's no apportionment of mortgage interest expense, because if a taxpayer deducts uses a standard deduction, it would be apportioned up above on line 3. But you might still have other business interest expense or other types of interest expense which you need to apportion on 4B, but line 4A would not be necessary. Back to you. Hopefully that answers the question.
Thank you, Jim. We appreciate that detailed response. I'm going to go ahead and move on to our next question. And Karen, I am going to direct this question to you. So what does it mean by sourced by partner in column F?
Sure, Anika. I think our instructions are really helpful on this. The instructions to the schedule K2, K3 for the 1065. We also have similar instructions for the 1120S. And basically what this means is that some of the rules that for how an item of gross income is sourced or how an expense is allocated and portioned cannot be determined at the partnership level because the rule requires that the source of the gross income or the allocation and apportionment of the expense be done at the partner level. So, for example, today we've talked about interest expense, and as I was further explaining the fourth polling question, I explained that the allocation and apportionment of interest expense is not solely dependent on the partnership's assets. It also looks to the partner's assets. So that's an example of an expense that cannot be determined solely at the partnership level in terms of how that expense reduces foreign source income and U.S. source income, because at the partnership level, there is not the information about the partner's assets. So we would say that interest expense is a type of expense that needs to be determined at the partner level, and that is why we put that expense usually in column F. There's also similarly gross income items, and that would be typically under Section 865. The source of a sale is generally determined based on the partner's residence as opposed to the partnership's residence. And so that would be a type of gross income that would need to be determined at the partner level. And so that type of sales income, for example, would be included in column F.
Karen, thank you so much for that very detailed information. I hope that was beneficial to our audience members and that you had some takeaways from that. Okay, so Jim, I'm going to direct this next question to you. If a taxpayer owns less than 10% of a domestic LLP, let's say a big accounting firm, a big dollar accounting firm, but is actively working in the LLP, what rules will we apply to apportionment of home mortgage interest? And will it still be under the less than 10% ownership passive category?
Yeah, that's a very good question too. I'll try to answer that, but if Karen wants to chime in, please. So to me, based on the description in the facts of this question, this partner working for a Big Five or Big Four actually accounting firm actively, to me, would be a general partner rather than a limited partner. So I think we have to try to define the capacity of this partner, whether in fact the partner really is working as a general partner. Now, if the partner is limited partner and owns less than 10%, of course, then the rules applicable to that type of ownership would apply to a portion of mortgage interest. Karen, do you have something to add to that?
Nope, that's the way I would have answered it as well, Jim. Thanks.
All right, Jim, thank you so much for that response. I think we have time for another question. So, Patty, I'll direct this one to you. Is the allocation of the partner's individual mortgage expense only required if the partner has met the foreign income threshold?
Thank you, Anita. Basically, in regard to this question, we're looking at taxpayer on the individual side. So if the individual total income his foreign source income is less than $5,000, then you would only be apportioning it all to domestic, or it would be considered all U.S. source for that purposes. If they had more than $5,000 of foreign source income on the individual side, then it would have to be apportioned. And you would factor in any interest expense that they have on their return, to allocate interest expense allocation based on the sourcing rules.
Okay, thank you so much for that response, Patty. I think we have time for at least one more question, so I am going to direct this last question to Karen. Why would an individual have interest expense other than home mortgage interest?
Right. So this reason why we thought it would be helpful to do this webcast, we have received a lot of questions on this particular subject matter because it is rare for individuals to have interest expense other than home mortgage interest expense. And the reason why in this particular fact pattern they would have interest expense other than home mortgage interest expense is because of their ownership in the partnership. And so it wouldn't necessarily be as rare for the partnership to have interest expense that is in these different categories that we've discussed today. For example, the business interest expense, the passive activity, and the investment interest expense, as well as the assets associated with those that would generate those types of activities. And so that's why we wanted to focus on that today, to explain these special rules in the case where an individual has an interest in a partnership, so that they would be aware that for these types of interest expense, generally the rule is that that interest expense would be apportioned based on assets as opposed to home mortgage interest expense, which I think most individuals are more likely to see, which would be apportioned based on gross income. Thanks.
All right, thank you so much for that response. So audience, it looks like that's all the time that we have for questions. I want to thank Jim, Patty, Karen, and John for sharing their knowledge and expertise and for answering your questions. But before we close the Q&A session, Jim, did you have any key points that you wanted attendees to remember from today's webinar?
Yes, Anika. I think the key takeaway from today's webinar is, number one, the rules of apportioning interest expense depends on first of all, the type of interest expense. And so for mortgage interest, it's based on relative foreign source gross income in an income category over total gross income from all sources. And then secondly, if the taxpayer has an interest in a partnership, that taxpayer must take into account his or her share of the partnership interest expense and also the distributive apportionment factors to apportion the different types of interest expense. And back to you, Anika.
Thank you so much, Jim. So audience, if we are planning additional webinars throughout the year, so to register for all upcoming webinars, please visit IRS.gov, do a keyword search for webinars, and select the webinars for tax practitioners or webinars for small businesses. When appropriate, we will offer certificates and continuing education credits for upcoming webinars. We invite you to visit our video portal at www.irs.gov. There you can view archived versions of our webinars, but please note continuing education credit and certificates of completion are not offered if you view any version of our webinars after the live broadcast. And a very big thank you to our speakers, Patty Miranda, Jim Wu, John Lee, and Karen Kate for such a great webinar. Thank you for sharing your expertise, for answering our questions. And I also want to thank you, our attendees, for attending today's webinar, Mortgage and Other Interest Expense Allocation and Apportionment for Individuals with Partnership Interest, Form 1116 and Schedule K-3. Now, if you attended today's webinar for at least 50 minutes from the official start time of the webinar, you qualify for one possible CE credit. Again, time spent chatting before the webinar started does not count towards the 50 minutes. If you're eligible for continuing education from the IRS and registered your valid PTIN, your credit will be posted in your PTIN account. If you qualify and you have not received your certificate and or credit by October 23rd, please email us at cl.sl.web.conference.team@irs.gov. The email address is on the slide as well. And if you're interested in finding out what your local stakeholder who your local stakeholder liaison is, you may send us an email using the address shown on this slide, and we'll send you that information. We would appreciate it if you take a few minutes to complete the short survey before you exit. And if you like more sessions like this one, just let us know. If you have thoughts on how we can make them better, please let us know that as well. If you have questions, if you have requests for future webinar topics, or you have pertinent information you'd like to see in the IRS fact sheet, tax tip, or FAQ on IRS.gov, then please include your suggestion in the comments section of the survey. The survey button on the screen, click the survey button on the screen to begin, and if it doesn't come up, make sure you disable those pop-up blockers. It's been a pleasure to be here with you, and on behalf of the Internal Revenue Service and our presenters, we would like to thank you for attending today's webinar. It's important for the IRS to stay connected with the tax professional community, individual taxpayers, industry associations, along with federal, state, and local government organizations. You make our job a lot easier by sharing the information that allows for proper tax reporting. Thank you for taking time out of your day to attend today's webinar. We hope you find the information helpful, and you may exit the webinar at this time.